Hello, welcome back to the continuing lecture in financial statements. This would be video number 7, so it's been longer than I hoped it to be, but that's the nature of this. That, that's the nature of this discipline, this field. I mean. You can just skim the surface, but have gain no insight, or you may struggle to go deep into the and take time, a lot of time to break it down and go deep and gain a solid systemic understanding and insight about it. So and I'm always pursuing the letter, so it's inevitable, if it takes that much time, we'll have to, so be it. Now, so in our last lecture, we discussed, how ROA and ROE can be measured, but then we also came up with some concepts like, book value. Now, let's think about it. So suppose we are, so let's say we are and we are calculating the book value, right? Let me try. Can I try? Let's try this time. Let's start this up. So ROE, return equity, is then calculated as profit over equity. But then, here's the thing. Now let's think about it. Profit is also called EAT. Net profit is called EAT. So let me change that to. Okay. Never mind. I'll just keep writing like this. EAT over equity. Now, here's the thing. We must consider the time dimension. I mean, we cannot ignore the time dimension. In other words, what I'm saying is, ROE, return on equity, is measured as of when? Now let's think about it. As of when? It can be measured at the end of the year, isn't that right? Because you want to know, I mean, if we are at time 0, which is the beginning of this year, as well as the end of the last year, right? And then ROE at time 1, I mean, we will measure, when do we measure profit? The profit will be measured, first year profit will be measured at the end of the first year. In other words, this EAT is the EAT at the end of year one. Right? Isn't that right? Yes. And so that means our return on equity is actually return on equity at time one. Right? Now, and the equity, let's think about equity. Um, Basically, this profit is the result of the workings of the equity. I mean, the reason we are measuring ROE is to just the same rationale, same reasoning as we measure the gas mileage, right? In other words, um, profit is the result of the workings of equity. So that's profit is the output, equity is the input. Make sense? Now, and this profit is the result of workings of equity as of when? Hmm? The equity, this is the equity at time zero, if you think about it, isn't that right? In other words, profit is measured at the result of workings of equity that was in place at time zero, and the that equity worked hard for 1 year and produced this result. So this is the fruit of the EAT at time one is the fruit of the workings of the EA equity at time zero. Make sense? So that so if we think about this time dimension, we can easily you can understand that we need we need first of all, of course, income statement and balance sheet, but then we need the balance sheet at 2 points in time. I don't know what's happening here. It's actually equity at we need balance sheet at time zero, and we need balance sheet at time one, right? What you're seeing here is only balance sheet at time zero, right? But think about it. 1 year later, balance sheet is like a snapshot, right? So it's a static states, right? A snapshot picture. So we have all the total assets listed in the values in the book. That's called book value, right? Because it's recorded at time zero, recorded at time zero, right? All the liabilities and equity also recorded as of time zero. And then 1 year later, at the end of that year, then all of these will have changed, right? So we will need a balance sheet at time one as well. And also the reason for the change is due to the operating activity, and the operating activity is recorded in income statement, and this net income, net profit, or EAT is recorded at the end of the year. It's the result. Think about it. You cannot have fruit at the beginning of the year, right? The harvest will come at the end of the year. So this net profit is as of the end of the year. And if you think about it, at least you can tell that the equity will have changed from time 0 and time 1. In other words, equity at time 1 will be greater than equity at time 0. Of course, it can be less, because if the company has made company has done a good job and made a lot of profit, right? At least the equity will value will increase by as much as the profit. In other words, equity at time 1 is the result of equity at time 0 and EAT at time 1. Understand? Purely in terms of book value. Why? Is EAT equity? Then the next question is net profit, is it? Yes, it's equity. Think about it. In terms of nature of capital, I mean, EAT is profit, and where does the profit belong to? I mean, is it equity or is it debt? It's clear, it's equity without question. Why? Because who does this belong to? Who does the profit belong to? Profit belongs to the owners. Isn't that right? If profit belongs to the owners, then in terms of nature of capital, right? There are only two types of capital, equity or debt. In terms of nature of capital, what is it? It is equity, because it's owner's capital. Isn't that right? So in other words, EAT is a equity generated by operating activity, right? Equity generated by operating activity for 1 year. Right? That makes sense. It's generated by, because there are two types of capital, two types of equity. I mean, of course, you say two types of capital. Oh, debt and equity. Yeah, but also in the sense, in terms of where that capital came from. In other words, original equity at time 0 is the capital. It's called capital paid in by the investors. Make sense? Equity at time 0 is paid in capital. In other words, paid in capital. Right? You see what that means? Paid in capital. They it came from the investors. Whereas this is an equity that is generated by the firm, by its own operating activity, right? The firm generated this equity, but it belongs to the owners, because think about it. If you have an orchard and you have apple trees, right? Apple trees are like your equity at time 0, right? And the EAT is the fruit, the apples, the fruit of the tree. And then, of course, apple is not the tree, but when you sell those apples, right, you can buy new trees, right? In other words, then if previously you had 100 apple trees in your orchard, but with additional with the profit, in other words, with the apples, you sold those apples, and the apples were worth 10% of the original value of the trees. Then you can buy 10% more trees, right? And then you have 110 trees, apple trees, which will increase the productivity and which will increase the production level by 10%. Output capacity increased by 10%. Right? That makes sense. So that's the connection, right? Now, then our next question is, if the share price, what is the share price? Share price is, stock price. There are two types of prices: market price and book value. And once again, market price is determined by demand and supply, but book value is, first of all, book value, that means, and then PS, per share, book value per share. Why? Now, suppose the equity was, 4 billion. I mean, this company had $4 billion of equity at time zero, right? So then book value per share at time zero is equity, book value of equity at time zero divided by number of shares. Isn't that right? Because that's the definition of what per share means. Number of shares outstanding. I'm not going to write outstanding. Outstanding means, held by investors. And because, some stocks can be repurchased by the company with the purpose of, artificially raising stock price. But anyway, that's by definition book value per share. Okay. Then we understand that the EAT is profit, but net profit, but it is it's an aggregate concept, right? In other words, profit we are talking about is the total profit for the company. But for individual shareholders, what is the portion of that profit? Of course, for me, I mean, for individual investors, if I'm holding 10 shares of this company, right, my share in that profit can be calculated by profit per share, which is simply dividing the profit by number of shares, right? And then the profit per share times 10 shares that I have. So actually, profit per share there's another name. It's called earnings per share. Okay, but what is earnings per share at which time point? Which point in time? Of course, we have earnings at earnings after taxes at time one. So our earnings per share is at time one, right? That's earnings per share at time one, which is simply EAT at time one divided by number of shares. Makes sense? Then now think about it. Then we can, what's going to be then book value per share at time one? Well, then book value per share at time one, I might say, oh, then that must be Isn't it simply equity at time 1 isn't it simply equity at time 1, right, divided by number of shares? Yes, that's true. But also, we can rewrite it as book value per let me do it this way. But then by definition, right, what is equity at time 1 is equity at time 0 plus EAT, earnings after taxes at time 1, divided by number of shares, right? But then we can break it up, right? In other words, what is then equity at time 0 divided by number of shares? It's exactly book value per share at time 0. And then what is EAT? 1. What is that? What is EAT over 1? EAT at time 1 over number of shares. That's earnings per share at time 1, right? In other words, it's exactly reflecting, right? What is earnings per share? It's profit per share. So in other words, book value at time 1 will reflect exactly the profit, right? And that's why I said, when you sell, I mean, if you want to cash out your profit, then all you need to do is sell your stocks, because your stocks will reflect. I mean, if you are holding, if you bought that stock at time 0, and 1 year later at time 1 you want to sell it, then whatever you paid at the time, the stock price at time 1 will exactly be greater than book value per share at time 0 by earnings per share, right? In other words, it will reflect, the stock price will reflect exactly the profit, right? In other words, the increased value due to operating activity. Now, again, what I'm saying is, this is the book value. Market value will deviate from this. Market value will deviate from this because market value is not exactly the same thing as the book value, because market value is the result of demand and supply. But this mechanism explains very succinctly how these concepts are related. Okay, so that wraps up our discussion about the intro to financial statements. Again, this is the 7th video, and we will stop here for this topic, right? There are other videos, 1 hour long videos, labeled, financial statements part 1, part 2, part 3. We don't have time for all that. I mean, since this is pre-recorded video, if you're interested, you can view them outside, scheduled class time. But for the purpose of our class, this will be the last video. And of course, it's important to at least go into financial statements part 1 video, because there's further explanation. There's further explanation to the minor line items in current assets and current liabilities. Actually, if you can watch, financial statements part 1 and 2, that would be great, right? In your own time. Okay. Alrighty. So that's it for this segment of the video. I'll see you guys in the next class with a new topic. Okay. Stop recording.